Hello, everyone. I'm Andrew Tam, and I'm joined by my colleague, Varun Venkatraman, and we're both equity analysts at CFRA based here in London. Now, before we start, our discussion is obviously for informational purposes only, and is not a recommendation to buy or sell securities or engage in any investment activity. Now, with that out of the way, Varun, it seems like it was only yesterday that we were talking about the reasonably strong 2021 results as companies began really to rebound off those pandemic 2020 lows. And yet here we are with Russia's tragic invasion of Ukraine and a new round of uncertainty as stock markets price in a brand new crisis.
Hi, Andrew. Yes, that feels like a lifetime ago. What we've seen is a broad sell-off since the Russian invasion of Ukraine broke out. We even published a thematic research piece about this on CFRA's MarketScope Advisor platform titled European Equities, Putin Risk in Perspective. When we published it, the S&P Europe 350 index was off around 9% year to date. But within that, we've seen energy stocks trade higher, while IT, consumer discretionary, and industrials have all been hard hit. If you've seen some of the price action in industrial stocks, you would indeed be surprised at the modest overall correction so far, where some of the falls have been larger and the selling feels a little indiscriminate.
Yeah, no doubt. Some of the price action and I guess some of the falls certainly remind me of what we saw, I suppose, what we haven't seen since the initial COVID-19 lockdowns, when really the market was gripped by, I guess, a similar level of uncertainty of what the virus meant and its negative implications. Well, since we published that report last week, I mean, the S&P Europe 350, now that's down almost 13%. And, the selling has really continued into the start of this week. A little bit of a recovery today, being Wednesday. But what started out as being a fairly modest sell-off has really intensified, just as the war, I suppose, has intensified. So, Varun, when we have a look, are your company seeing much of a direct exposure to Russia or even Ukraine?
Yeah, look, taking a step back and just looking at the stocks we cover, the overall level of direct exposure to Ukraine and Russia has been relatively limited. Names such as Coca-Cola, Hellenic, and Renault, as well as Carlsberg to a lesser extent, seem to have substantial amount of direct sales and operating earnings in the Russian market. In these cases, the imposition of sanctions is certainly going to make life difficult for them. And then you have a few energy names on the other hand, such as Fortum and OMV. While they're beneficiaries of elevated energy prices, they were large investors in the Nord Stream 2 pipeline project, which has since been cancelled by the German government despite having been fully built.
Yeah, it does seem somewhat of a mixed bag, I suppose. So whilst there are names that you reference, there's also a long tail of stocks that do have some level of exposure to Russia, but that really is in the low single digit levels. And it's certainly not the apocalyptic type stuff, is it?
No, definitely not. And I'd argue that if we were just looking at the direct exposure, then perhaps the market's actually overreacted. But Europe in particular remains highly dependent on Russia for its energy needs, specifically with lack of diversity in where it sources oil and gas, which is why the initial sanctions on Russia had specific carve-outs for energy, because clearly the sanctions would then do more harm than good. But with the US announcing a ban on Russian oil and gas in a coordinated response with Europe, that's seen Brent oil price spike up to over 130 earlier this week.
Fair way away from, the negative oil price phenomenon that we saw during the initial COVID-19 pandemic, that's for sure. I mean, the reality now is that if these high oil prices are going to be sustained, what does it mean for global inflation? And more importantly, the level of demand destruction that we could potentially see in terms of the global growth, just as it was kind of recovering from, the initial depths of the pandemic. So certainly investors are trying to price in some of that at present, I think. But the sell-off does look indiscriminate, with the baby thrown out with the bathwater, so to speak.
Yeah, agreed. And it's not just the energy spike that is the cause for concern, right? Everything from soft commodities like barley and wheat have rallied to hard commodities such as iron ore and understandably gold as well. Some of that will be due to the fact that Ukraine was such a large exporter of soft commodities. The disruption and the potential for shortages means that supply chains, which are already stressed from the pandemic, are going to be stretched even further.
Yeah, totally. I mean, the reality is that these high production costs are going to ultimately be passed on to consumers. So inflation's probably going to remain fairly elevated for a lot longer than people anticipated, and certainly not the transitory view that some central banks were talking about this time last year. Now, that comes at a time when wage growth, at least, is still pretty subdued in the low single digits, meaning really consumers are facing a really unprecedented cost of living squeeze. And to some extent, household savings, they're still elevated from pre-pandemic levels. So there is an element of a buffer or an offset in the near term.
Yeah, it's not all gloom. Some companies are still benefiting. The obvious examples are the energy sector, as we mentioned earlier, but other names such as farming equipment suppliers, CNH Industrial, they're seeing record levels of demand for their precision agricultural machinery, while others such as Siemens, who have a huge spread in terms of earnings diversity from both a geographic perspective and users in end markets such as electrification, renewables, robotics, and so on.
Yeah, for sure. And I guess you see the same within the automotive sector. They've seen all sorts of production disruptions, and really they rebounded strongly in 2021, and then were hit by the semiconductor shortages during that recovery phase. But really, if you look at some of their 21 results, I mean, the lost volumes didn't really necessarily equate to lost revenues or sales, as really their pricing held up remarkably in the face of what was a really strong level of demand. So with those supply chain shortages likely to be elongated, there's every chance that that pricing dynamic's going to remain firm. And so, yeah, their margins are probably going to be okay there.
Yeah, so there you have it. We've gone from a plague into a war. And so far, the year-to-date price reaction of European indices seems to have been fairly muted, although specific stocks have been hit a lot harder. We can only hope for these hostilities to come to an end soon, but in the meantime, we're in for a heightened period of volatility as the war intensifies. And as always, with heightened volatility, we think there'll be more opportunities for astute stock picking. So thank you for your time, Andrew.
Thanks, Varun.